Hello and welcome back everyone to the Moneycontrol live stream. You are watching markets with Santo and CJ in association with M Stock by Mere Asset. Well, it's a very volatile and choppy session on Dalal Street today. It seems investors are very reluctant at this juncture to take any bets on the downside or the upside ahead of a very crucial meeting of the US Federal Reserve whose outcome will come out later in the evening. So clearly, if you look at the Nifty and Sensex, they have now turned into the red territory after spending most of the session in the green territory ahead of that US Fed meet. Curiously though, Santo, the second line stocks is the mid cap and small caps who are the one outperforming today. Both the Nifty mid cap and the small cap 100 indices are in the green at this juncture. Apart from that, if you look at some of the sectors that have been helping the Nifty out overall throughout the session, it was banks and automobile stocks which are the leaders on the gainers list, while some of the oil and gas names were taking a little bit of a hit on the downside. Overall, Santo seems like, you know, that lull before the storm sort of a situation, in your opinion?
Yes, it looks like that. And also, CJ, you know, one of the tricks of growing your wealth in the market is that for long periods you just need not do anything. So probably, you know, the market being sideways, lackluster.
But how can you live with that inaction, Santo?
It's but that's how you protect your wealth and grow it. You know, if all the time, you know, you keep punting on stocks, then obviously you're going to land in trouble. That besides that, you're seeing some serious cutback. That's the sense I'm getting from speaking to brokers and dealers, that HNIs and retail investors, you know, till about a month back, they were buying the dips. But since then, at every dip, you know, the amount of money that they've been committing has gone down considerably, and most of them are now watching from the sidelines. So even though you're seeing some kind of a bounce in second line stocks, it's not really on the back of renewed buying interest. Also, what people in market circles have been saying, that broking firms have taken a serious hit to their revenues over the last month. So the numbers for this quarter will be definitely very interesting and worth watching.
Yeah, I mean, probably a lot of even retail investors are taking your advice and maybe staying on the sidelines and not trying to jump in too aggressively. But clearly, there has been also some buying happening from the retail and domestic investor side, and of course that has been the support for this market over the past 6 to 7 months, without which we would have not probably been in a worse scenario that we are in at this juncture. That said, there was a lot of stock action, even though the indices were quite lackluster. Individual counters were in action, starting off with Santo.
Maruti Suzuki. Now, Motilal Oswal has come out with a buy recommendation on the stock, and the optimism mainly stems from the fact that Maruti is, after a gap of almost 3 years, the Maruti has now got a very strong product pipeline for the next 2.5 years, and the brokerage has said that, you know, between FY14 and FY19, when the company was able to grow its market share, it was largely on the back of, you know, new launches. You'd seen a flurry of launches. After that, for almost 3 years, you didn't see any major launches, and you also correspondingly saw the company lose its market share. One of the big problems for automakers in general has been that semiconductor supply shortages and also rising commodity prices. Both these headwinds are expected to abate now. That will be further good news for Maruti Suzuki's margins. And Motilal Oswal has a price target of 10,000 rupees on Maruti.
10,000 rupees. I must say, I mean, Motilal is being very optimistic here, Santo. Yes, I take the argument that, okay, probably in the past, whenever Maruti has come out with number of new products and new car upgrades to its existing cars, it has tended to gain market share, no doubt, right? But let's look at it this time around. This time around, Maruti is not trying to get into the, get new launches of products into the entry level segment where it is the king right now, right? Nobody can dominate the entry level segment in the passenger vehicle space like Maruti can. But now it is trying to get into the SUV space. Now, SUV space is something where Maruti's forte does not lie, or it has not so far. That is one space that has been, for years been dominated by the likes of Tata Motors and M&M. And in my opinion, I feel that therefore it will be very difficult for Maruti to see the sort of price, market share gains that Motilal Oswal is talking about, that probably it would have seen in the past. So that for me is one concern. Apart from that, if you talk about also the segment that it dominates, the entry-level segment, demand, trends there have been a little sluggish, I would say, compared to the premium and maybe even the luxury car market where you have seen booming demand. the entry-level segment demand has been quite sluggish and choppy, and that is the main reason for that is the high cost of ownership. I mean, insurance costs are rising, the cost of fuel is rising, so clearly consumers out there are not taking a bet at buying a new car in the entry-level segment or the hatchback segment, as a lot of people call it. So for me, these two trends, will probably limit the sort of market share gain that Maruti can see compared to what Motilal Oswal is saying. Lastly, I feel that the margin threat is still not abated clearly. Yes, the steel prices might have come down or might come down going ahead in the domestic market, but overall commodities are at an elevated level compared to where they were 2 to 3 years ago, and clearly it will take a lot of time for Maruti to recover the sort of peak margins it used to have once upon a time. So for me, at this point of time, the optimism may be a little early, maybe 3 to 4 months a little early. I would want to see the June quarter and September quarter performance.
Well, CJ, there was a time when Maruti was synonymous with entry-level vehicles,
it
but
still
that
is,
I don't really think so, because it's SUVs are now maybe not selling as much as some of the bigger ones, but it's definitely there. You do see plenty of Brezzas and Ertigas, and now XL6 also on the roads outside. So I disagree with your assessment that it's purely an entry-level place. Secondly, this is a natural progression for any car maker, right? The entry-level segment is only going to be that much. It just can't be focusing there all the time.
True. Maruti's management has known this fact for a long time, but it's been 20 years and Maruti has been trying to break into that premium segment, and it has still not been able to make a name for itself the way it has been able to in the entry level.
That is reflecting in the prices. CJ.
Maruti will always be everybody's first car, but it will never be somebody's second or third car, in the sense that those who are more ambitious, they want to own the bigger and the badder cars out there, not your Maruti. Maruti's name is associated with your first car. It will always be that. It will always be any average Indian's first car. But I just don't think Maruti has that branding to go and capture the premium or the luxury segment the way maybe some of its rivals have.
That is what gives the opportunity, CJ. Probably the market is having a very pessimistic view the way you are having.
Yeah, I think market is God, Santo. Market always is right ultimately at the end, and we will see how it works out. That's at one stock where the market at this point of time does not look in the favor, but I feel in the longer term this could turn out to be positive, is Sun TV Network. Now, why Sun TV Network? Because Sun TV owns an IPL team called Sunrisers Hyderabad. Now, we all know the entire brouhaha around the IPL media rights. Now, these rights, the deal that auctions that have happened, almost 48,000 crores raked in by the BCCI through the sale of TV and digital rights. This is going to be a bonanza for Sun TV's IPL team. This will clearly boost, more than double its Sunrisers Hyderabad's revenues, as well as almost treble their pad going ahead. So clearly a big boost to not only the earnings of the IPL team, but as well as the valuation. If you look at what Elara Securities has to say, they expect the average valuation of an IPL team to go up by anywhere between 15 to 20% going ahead on the back of this media deal. So clearly, overall, I think this will contribute to Sun TV's own market capitalization. Now, Sunrisers Hyderabad accounts for a fair chunk of Sun TV's own market capitalization, Santo. So this is going to be a good boost in the near term for the stock.
Well, CJ, I take those points, but the stock has been among the cheapest media stock for a very long time now. It's down by close to about more than 60% from its peak it had last seen in 2018, and there are strong reasons for that. I'll come to that a little later. But the immediate reason what is keeping the stock depressed is that its inability to really scale up on the OTT side, despite the company having sufficient cash reserves for that, but still it's taking its own time. It has about 24 million odd users at this point, but these are not organically. It's all through various bundled offerings that Sun TV has managed to get all these users, and they have not shown any stickiness so far. There's a bigger reason why institutions have steered clear from the stock, and you saw that again in sometime in February this time. Institutions had opposed the reappointment as of both Kalanithy Maran as well as his wife, Kalanithy Maran as non-executive chairman and Kaveri Maran as the executive director. But however, the resolution went through. Besides, they're being compensated close to about 87.5 crore, which is very high for somebody of a executive director stature, and with a 25% increment on top of that, and still the resolution went through. So clearly institutions are not happy with this, and you're seeing that protest in the stock's underperformance over the last many months. Besides that, Sun TV right now, according to Moneycontrol Pro, is also losing ad revenue market share in key southern markets besides Tamil Nadu. Other than that, its foray into Bengal has also not been very successful so far. Now, why OTT is very key to the company's fortunes is that there is right now an embargo on increasing your subscription channel for the channels, right? So that means that you need strong revenue, an additional strong revenue stream, which is not coming right now because they are not investing enough in OTT. So all this makes me very bearish, negative on the stock. CJ.
Now, Santo, on the fundamental side, I feel that a new tariff order is a matter of time. It's not about if, it's about when that order is put out of abeyance, and clearly the DOT will come out with something on that front, TRAI will come out with something on that front. Apart from that, fundamentally, yes, ad sales and market share losses have been there for Sun TV because of rise of competition from Star in the Southern Indian channel. But I think overall, the company is trying to get its act together on that front. As far as the protest on the promoter, participation is concerned, I see that as a very short-term blip. Ultimately, fundamentals speak in the market. If your earnings are growing, if your stock is performing well, I don't think market can have too much complaint on that regard. So clearly for me, given the boost that the valuation we're going to get from a non-core activity already, and with the core activity also looking up over the next 2 to 3 years, I feel this is one stock where there could be a contraplay in the offering.
But the stock is still struggling,
Yes, I know.
despite all the news about, not winning, not having that winner's curse, and IPL teams benefiting more. Still, institutions are not willing to take. And CJ, the stock has now remained cheap for a very long time. Plus, the earnings, both top line and bottom line growth have been fairly tepid over the last almost 5 years.
Yeah,
now.
Of course, you were in 2 years of COVID period. I mean, what top line growth will you even get?
Even if you net that off, and if you see that, the earnings growth has not been all that great. So the stock has been, it's a good business. I mean, analysts don't dispute the fact that it's a very good franchise, very good business. Still, it's remained cheap for such a long time, from almost now more than 4 years now.
Yeah.
It used to be.
But these 4 years have also been dominated by the new tariff order, chaos that has been around that tariff order business, as well as COVID-19. So I think those are two factors or events that compensate for that sort of a tepid revenue performance that you have seen from the stock over the past 4 years, Santo.
Well, another stock in the same segment, and also which has escaped the winner's curse is Zee Network. So Zee Limited, the stock is among those which have been struggling. In the overall outlook on the media sector has been quite bearish, but the positive for Zee again is that it has not backed the IPL rights, so that's a big plus. But the bigger play here is that it's been able to grow its OTT platform pretty well. The user base, according to Moneycontrol, has almost doubled from about 4 million odd to about 10 million odd in the last couple of years. And besides that, in among non-English channels, which is among domestic ones, Z5 is doing pretty well. And given the intense competition in the English and Hindi segment, it's now trying to branch out into the vernacular space, other states as well, and creating content there. Also, if you look at both in terms of monthly average users as well as the time spent on Z5 platform, that has almost doubled over the last 2 years. This despite offices, resuming. And in addition to all this, the impending merger with Sony also spells good news for this company, CJ.
True, Santo. I mean, the merger, of course, was the big, kicker for the stock. I mean, we remember the move almost 40%, 45% in a day when the merger was announced. But I feel that, one of the bigger concern for that merged entity is the high debt on the balance sheet. And probably that was also one of the reasons why a lot of analysts did not want Zee and Sony to go gung-ho over the IPL media rights. And therefore, there has been relief on the counter that thankfully, mercifully, these two companies have not gone for the media rights, because that would have just bloated the balance sheet even more going ahead. Apart from that, if you look at the fundamental side of the business, advertisement, of course, subscription has been driving revenues during the COVID period, thankfully for the company, when ad sales were weak. But ad sales, while recovering a little bit over the past 6 months, have again, the outlook on that side of the business has again deteriorated. You are seeing the sort of cutbacks that FMCG companies and some of the other sectors are doing at this juncture because of high inflation. They want to manage costs, and the first avenues where you cut down on cost is on promotion and marketing, and clearly that is going to weigh heavy. Also, let's not forget, one of the big boosters for advertisement industry last year was the cryptocurrency market, right? and we all know where that market is at this juncture with the sort of opinions that have been coming out of the government as well as the industry bodies. Crypto ads are likely to face a big slowdown going ahead. Apart from that, one thing that also bothers me a little bit is that there has been some talk that Hotstar will probably lose a big chunk of its user base going ahead in its OTT platform because of the lack of IPL cricket matches. But I don't think it will be so much of an upside for Z5 going ahead, because even though Z5 has been able to double its user base, it's not yet been making money out of it, right? The market is still not convinced about the viability of the OTT platform when it comes to contributing meaningfully to the company's business, to its operating profit. It's still a loss-making entity. Zee has already put in a lot of money into it, but it's very shy of now putting more money into it going ahead, even though it has somebody like Sony backing it with more than a $1 billion cash chest. So for me, Zee at this point of time looks a very iffy stock. We will have to wait and see how the merger dynamics play out, what sort of synergies we see, and what sort of appetite we see in terms of from the management for going after growth. So clearly something that I would at this point of time steer clear of.
So ad revenues have been under pressure, I mean, no doubting that, but the good part about Zee is that it also has got multiple levers. So for instance, its film distribution business did very well in the fourth quarter. Two big blockbusters there. One was Kashmir Files and the other was Gangubai Kathiawadi. So both these films delivered well. In fact, revenues from film distribution were a major chunk of Zee's fourth quarter numbers. Also, if you see, there's also Zee Music. The company has not given out full details on that, but here is a company where you got multiple levers. Right now the stock is underperforming, but in the media space, if one were to bet on all that, Zee still looks better placed than most others.
We'll see that out, Santo. One stock that does look good on the advertisement side of the industry is Affle India. Now, this was one stock that, of course, was the darling of the market in 2020, 2021, and then saw a big correction over the last year as rising interest rates and withdrawing of liquidity raised concerns over its valuation. Now, overall, if you look at it, after the healthy correction in the counter, clearly some brokerages are turning positive again on the stock. Anand Rathi recently initiated coverage on the stock with a buy rating. They feel that the stock has recently been rising on the back of a healthy outlook for earnings as well as demand going forward. They believe that Affle's business model of basically getting paid when you have converted users, when you say if you're putting out ads for a app or a business, they only make money when they convert a user for that business. Unless, unlike the general trend of based on clicks and engagement, etc., they feel that this sort of a business probably is less cyclical than the other sort of business other sort of model that is out there in the mobile advertisement industry. Overall, I mean, it's a given that the mobile advertisement industry is going to boom going ahead, given the way smartphone penetration is rising in India, the internet penetration is rising in India. Clearly, this is one sector that is in for good days and a long growth runway ahead. In 2022 itself, mobile advertisement spends in globally, Santo, are expected to rise almost 19% on an annualized basis. So clearly, this is one space where the growth runway is good, and now the valuations have also become quite affordable and attractive for investors to go take a bet.
Well, I was about to say that at 63 times trailing 12-month earnings, the stock is very expensive. But
at 45 times 2-year forward earnings, it's quite cheap, Santo. I feel.
Also that in the last 3 years, both its earnings at top line as well as bottom line have grown at 63%.
Exactly,
so probably, probably it is. But then 1/3 of the numbers, the other income component for FY22 was almost 1/3 the operating profits. That's so big chunk of that comes from other income.
But it will be a one-off. I think it will be driven
the
by
same similar was the case in FY21 also. On a lower, in absolute terms, operating profits were lower, but again 1/3 of that numbers came from other income. So this is my only concern on the stock. In the meantime, let's take a quick look at the market before we move on to the last stock of the day. Well, it looks like indices are set to finish the day on a gloomy note.
Yeah,
CJ?
clearly, Santo, I think we have extended our losses since the time we started the show. The Nifty and Sensex are now down 0.3% each, but the Nifty Bank is holding out. It was flat when we started the show, but has now risen about 0.1%. Clearly, is the mid-cap and small-cap stocks which are the major winners in the day today. Santo is the second-line stock that are probably seeing some bit of bargain hunting, and probably also an indication that retail investors are still ever present in this market. They are not giving up on this market as of yet.
Well, the bounce is coming on the back of low volumes is what I keep saying, CJ.
The selling also came on the back of low volume, Santo, in May. So don't forget that average turnover, daily turnovers in May were actually quite lower compared to April.
Because they just can't sell the stock. There's no liquidity, CJ. Whom do you sell the stock to?
Exactly, because whom do you have retail investors, the DII is buying it in chunks. So of course there are
the trend is, after some time when you're unable to sell the stock, people start selling it out for whatever price they can. Well, that said, the last stock on a watch list today is NTPC. Now, NTPC has been among the prominent losers of the day, but overall, if you look at the power sector as a whole, the outlook for power demand remains quite healthy even at this point, and PSU power companies are one good way to play it. According to brokerage firms, NTPC is better placed than most other power companies, independent power providers, because of unique arrangements such as securitization and tripartite agreements. Besides that, it's a known fact that state electricity boards are in poor health financially, but because NTPC, PSU power companies in general are covered under the escrow mechanism and they operate on a cost plus basis, the risk to their earnings is not so much. Not a very big jump in earnings actually. The outlook is between 6 to 10% growth in PAT over the next 2 years. But if you look at the overall macro environment, according to IIFL, this may not be such a bad number after all.
Well, Santo, yes, NTPC has been doing quite well over the past 1 year, and this year power stocks have been the it sector in that sense for investors. But I just feel the only concern for me would be on the recoveries side, whether they will be able to get the payment from state discoms who are under financial stress at this point of time for the power that they're generating. I think that will remain a key risk to the earnings outlook going ahead, and probably if we see more lower surcharge income in the June quarter as well. I mean, one of the disappointments of the March quarter was that there was a very low surcharge income. Now, surcharge income is the extra fee that they demand from discoms for the late payment on power generation. So clearly, if this income remains low again, that means NTPC is taking a hit when it comes to receiving income for the power it has distributed to state discoms, and that will remain a key concern and could limit the upside going ahead on the stock.
Well, the IPL, the sale of IPL rights has been making a headline for the last couple of days. But tell me, CJ, the winners who have managed to bag, the rights, are they ever going to be able to make money off it?
Well, Santo, clearly the brouhaha around IPL media rights and the money involved is crazy. I mean, last time these rights were, auctioned, they sold for what, 16,000 crore? Now they have almost tripled in value to 48,000 crores. Now, I mean, you talk about investing in stock market and real estate and what, I mean, probably being in that business, I mean, being in BCCI's place will be the best, most enviable place right now in this market.
Probably all those teams should get listed soon.
Yeah, I hope so. I mean, that will be great for investors as well. I mean, you get to play a different sort of a market, and different sort of sector. So clearly that will be a great setup. But let's talk about whether these companies who have, bought the media rights, you have Disney Star who have bought the TV rights for about 23,500 odd crores. And then you have Viacom 18 who have bought the digital rights plus some part of the international rights as well for a cumulative 23,000 crores, 23,000 crores. And Times Internet who have also got a chunk of the international broadcasting rights for about 2,000 to 3,000 crores. Now, overall, according to CLSA, Disney Star will need to compound its advertisement sales, Santo, by 15% on a year-on-year basis for the next 5 years.
Is that difficult?
To even break even. I'll tell you why that is difficult, right? TV advertisement is one segment that has actually been struggling over the past few years because of the rise of the behemoth that is digital advertisement. Now, one of the other, issue for TV advertisement is that a big chunk of it used to come from, sectors like betting. You had, I mean, during IPL, betting, companies were involved in the betting market. Their ads took off really big time in the past 2 years. So that is one segment that could come under pressure, especially after the recent diktat we have seen from the government coming in. Apart from that, surrogate ads. Now, these are ads, say, for example, you have an alcohol company which cannot directly, market its products, but it uses different sort of advertisement tricks, they call it surrogate ads, to probably maintain its presence in the mind space of the consumer. Now, those sort of ads are also being frowned upon by the government, and there could be possible bans on the surrogate ad as well. So these are two major chunk of ad revenues that could probably potentially will not be there in the next 5 years. Apart from that, you have the FMCG companies who are the big advertisers out there. They are cutting back on promotional activities, we all know, because of the rising costs overall. So clearly, the outlook on advertisement income does not look good, at least for the next 2 to 3 years. And if you have slow growth for the next 2 to 3 years, and you have only 2 years left in your contract to make up for it, it becomes an even more difficult task. So that is why for TV companies, it's going to be quite difficult to make up that the money that they have spent. According to some, it might take even four years for these companies to even break even on the cost that they have,
And the rights are just for 2 years.
Yeah, no, the rights are for 5 years. So you have display rights, broadcasting rights for 5 years, but you will only be able to break even, and that is to cover the cost that you have, put out in the 4th year itself. That means you can make profits probably only for 1 year. And is that enough incentive for you to, go out and splurge 23,000 crores? Maybe not. But why they do it? Because they don't want to lose market share. They do not want to lose that, the brand that they have in the heads of their consumers. If they are not probably displaying cricket for the next 5 years, probably consumers will even forget that they exist. So that is one risk that they have and TV producers take, and that is why we have seen such a premium bidding for TV rights. When you come to the digital side, Santo, there the growth is, the demand is even greater. Yes, digital user base is rising. A lot of people are switching off their TVs and switching on their mobiles and watching a lot of cricket, sports, entertainment on their mobile. But CLSA expects that digital right owners will have to grow ad sales at a rate of 57% on a year-on-year basis for the next 5 years to recover the cost that they have put out in this auction. 57% is a huge amount of growth that you are demanding from a company. Now again, digital, one of the drivers of digital advertisement over the past 2 years were what? Cryptocurrencies, betting companies, these sort of companies, right? Startups, yeah, these were 3 spaces which were dominating digital ads, and all 3 spaces are under pressure. Cryptocurrencies, we all know what has happened to them. Startups, they are under funding crunch, so they'll not be promoting that much out there. And of course, you have the other sector as well. So clearly, it is going to be very difficult to recover the cost that these companies have spent on these media rights. And probably you can call it a poison pill, you can call it trying to retain your market share, but making money is very difficult. And that is why I think Edelweiss Securities says that the only entities who actually make money in these auctions is the BCCI, of course, who owns the rights, and lastly the IPL teams, who are going to get more revenues going ahead.
Well, the market now almost close to that critical support level of 15,660. It's fallen to 15,685 now.
Yeah, I mean, it looks like we are going to close in the red, Santo. We're just 2 minutes away from the closing, so clearly we are going to close.
So
the
tell
day
us quickly, what do we need to look out for?
Well, it's the Fed, of course. The Fed meeting's outcome is going to come later in the evening, so that will be the most critical thing to watch out from. Apart from that, the US retail sales data for May will also come out, which will be crucial to understand how the US economy is faring in terms of the high inflation environment that we have there. So clearly, 2 major events happening, and yeah, the market will determine. Tomorrow morning we'll see where the market stands on the outcome of the Fed.
Well, with that, it's a wrap on this edition of Markets with Santo and CJ. Thank you for watching, and please do share your comments in the comment box below.
And do follow us on the social media links at the bottom of your screen. And for rest of your news, stay tuned to moneycontrol.com and the Moneycontrol app. We'll catch you again live tomorrow 9 a.m. with all the action.